What's going on, you guys? It's Royce Jacob. Welcome back to the channel. And in this video, I want to talk to you guys again about why I think we're about to see another significant pullback in the equity markets next month, which is July of 2020 at the time of recording this. So if you guys did happen to catch it last week, I did post a video talking about how this dead cat bounce, relief rally, whatever you guys want to call it, in the markets that we've seen over the past couple months was a bubble, why I think that bubble just popped, and I just kind of want to further expand on that theory. My general thesis hasn't changed, obviously, but if I'm talking about this, I am still bearish on the equity markets as a whole, but things are happening so fast right now, you guys. Like, on a week-to-week basis, things can change significantly, and unfortunately this past week the macroeconomic outlook is looking significantly more grim. So I just feel like it's important to keep up to date with this and just the general markets overall. Okay, so again, I do want to tackle this from both a fundamental and technical perspective. We'll take a look at a few charts. As you can see in front of us, we have the SPX open on TradingView, S&P 500. That's the way I'm going to gauge with these three charts, actually four charts that I want to show you. Gauge the general equity markets. I just feel like the S&P is a good way to sum up the equity markets as a whole. So we'll take a look at this chart, probably finish off with that, to be honest, but we will take a look at a few different time frames. So this one's covering some daily candles, so this is on daily time frames, a little more short-term view. This is very important, but very general. Okay, so this dates back like decades even, on the S&P, and I think at times like these, you guys, like, again, when things are happening so fast now, it's very important to keep the bigger picture in mind and just take history into account. Okay, so know the history. We'll take a look back in time and just see what's going on from a very, very macro perspective. And then we'll take a look at this. This chart is good because it kind of bridges the gap, in my mind at least, of technicals and fundamentals. So this is showing how realistically overvalued the S&P is right now from a PE ratio. Okay, so price to earnings ratio, it's a good way to evaluate. The PE ratio is a very general way to evaluate the fair value of a stock or a company. Okay, so we'll take a look at this. We will then, we'll actually kick it off with the fundamentals, because I do want to set a good fundamental grounds for the charts and the technicals. So we will actually start with these. So we'll talk about unemployment, the actually $600 like little bonus check. So I'll let you guys know why I think that's important. But we'll talk about the jobs report that's going to come out next month. Okay, so we'll quickly touch on these guys. I want to make this as fast as I possibly can. But before we do get into that, I will ask you guys to please give this video a like if you do gain value in it, and subscribe to the channel if you're new around here. Okay, so that said, let's get into the fundamentals, set this base layer, and then we'll get into the technicals after. Okay, so title of this, CNBC, fragile economic recovery faces first big test with June jobs report in the week ahead. All right, so I'm just going to read you guys the key points on this one. So the second half will be show me time for the market, which has been moving higher on the expectation of a V-shaped recovery after the coronavirus shutdowns. June's job report in the week ahead is expected to show that Americans are heading back to work, with economists forecasting 3 million jobs were added. The market will also continue to focus on the COVID-19 outbreak and its impact on economic reopenings. Okay, so we have been talking about this a lot lately, you guys. I know a lot of you know that COVID cases in a lot of the states that are reopening right now, so Texas, Florida, are off the charts. They're spiking to greater numbers than ever before. Even at the beginning of this pandemic, I personally think it's just kind of a lagging indicator. But that said, the numbers are up. The numbers are greater than ever. And these states that are beginning to reopen, like Texas and Florida, are actually withdrawing their reopening plans and taking a step backwards because the COVID cases are staggering right now. The numbers are staggering and frightening to a lot of people. Okay, so that's a very bad sign. Even prior to just this week, I think there was a lot of general optimism around the reopening. Like, states are starting to reopen again. People were getting bullish on the actual economy and thinking that the economy was actually going to catch up with the markets. So I do want to touch back on that. I do say this a lot, and I'm sure all of you guys know this at this point. But as of the past couple of months, the economy and the markets are two very different things. Usually they should be correlated to some extent, but right now the economy is in shambles. It's tragic, and the market's just been on fire. I do think that will change, and we may have pivoted. We have seen that pivot just in this past week, because the market did end red. And I believe, the trend has now began downward. But I do think that right now, optimism is definitely dying out, which again is sad, but you just have to keep things real sometimes, you guys. Optimism is definitely going downhill because people are seeing that as states reopen, the numbers of COVID are going up. They're starting to lock down again. And I personally never thought we would have a second phase of lockdown. Like the American will is just too strong. But that's what I thought. But again, states like Texas and Florida are initiating a second lockdown, which is very scary. It just sucks, to be honest. But again, we're keeping it real around here. We have to keep rational, stay objective. Okay, so that's that. We'll move on to this too. Okay, so the $600 unemployment benefits will end before July 31st. All right, so I highlighted a few key points. Not going to read this whole article, but for the tens of millions of Americans receiving unemployment benefits, the extra $600 boost will run out sooner than expected. Americans who are eligible for unemployment insurance receive an extra $600 on top of what they normally claim under their state's benefits. Yet this boost is scheduled to end on or before July 31st, 2020. July 31st falls on a Friday this year, which is a problem because states typically pay out unemployment benefits on a weekly cycle that ends on a Saturday or Sunday. And because of the wording of the CARES Act, that means states will end the $600 extra payments on July 25th or July 26th. So again, that's just a few days. It doesn't seem very dramatic, but I'm sure you guys know someone, or if not yourself, because again, like 15% of America is unemployed right now. I personally have many friends and family who are unemployed, and I know a lot of people who are receiving this extra $600 payment. And again, if you're someone receiving this, if you have a loved one or a friend who's receiving this $600 payment extra on top of unemployment, you know how significant that $600 is, okay? That's a very meaningful sum of money in terms of the check you're getting each week. All right, so that's a big deal. Just, again, one $600 payment cut off from that is significant. All right, so there's roughly 33 million Americans who are still receiving unemployment benefits or waiting to be approved, according to the Department of Labor. So once the extra $600 payments end, unemployed Americans will be left with whatever unemployment compensation their state typically pays out, the amounts of which can vary dramatically by state by state. Okay, so again, if you guys know anyone, if not yourself, you know these $600 payments, this $600 bonus on top of unemployment is a significant sum of money, okay? So that's bad just for consumer sentiment overall. That's kind of what I'm getting to on this. And again, that's a lot of what's kept markets propped up. Obviously, the Federal Reserve printing trillions of dollars, siphoning it into both into the markets as well as the hands of people, a lot of which is going into the markets. So a lot of this printed capital is going into capital markets and equity markets, okay? So that's definitely something that's been keeping the market artificially propped up. Not necessarily artificially, but that is what has inflated the market, and that is why I titled the last video "Bubble," because that is the definition of a bubble, when things get inflated, overly inflated, and irrationally inflated. Okay, so I'll just read this last little piece right here because again, it ties into the macroeconomic kind of picture. But it's not just those who are unemployed who will be affected. I think most people think that when the $600 gets cut off, that if they're not unemployed, it's not going to affect them. But when 30 million people are no longer getting $600 extra dollars, that's going to have a multiplier effect on the whole economy. Okay, you guys, so just butterfly effects, butterfly effects. When this $600 is stripped, when, again, this extra payment, which is a significant sum of money for all these people, is stripped, $600 times 30 million, that's a lot less capital flowing into the hands of people, flowing into the economy when this economy already sucks. Okay, so keep this in mind. Just keep an eye out for this, you guys, in late July. And I've said this before, summer months like July, August to September are typically just bad months for equity markets as a whole. Like that's just historically that way. It's not the case every time, but the majority of the time, summer months are just worse for the economy. You also have to take into considering the election. Obviously, like politics are a mess right now. Don't want to get political. Just try to keep this as rational as I can. But politics objectively are an absolute mess right now. So the elections are definitely going to interfere with the markets if they haven't crashed again by then. The trade war with China was just cut short because there's beef between U.S. and China. Like all the stars are aligning right now in the most negative of ways right now for the market. So again, very fundamentally bearish on the market. Again, the only fundamental argument I have for the markets right now is the Fed continuing to print trillions of dollars, which will take a toll at some point. Again, you guys, the economy, I don't want to say this is a fact, but I just have to believe that the markets have to catch up with the reality of the economy at some point. I feel like there's no way we can just keep things so like artificial and like so weird. The market's so weird right now, and the uncorrelation with the economy is scaring me personally. Okay, so that's it. Again, let's hop into this chart. I really like this chart. This is by Yardeni Research. And again, this bridges the gap into my mind between the fundamental and technicals, okay? So this right here is the S&P 500, okay? This is, I'm sure, what a lot of you guys have looked at, chart from 2008. And as you can see, the S&P is pretty scary because we're pretty much at all-time highs, right? So again, economy, markets, obviously two very different things. We're pretty much back to all-time highs. We're literally higher, even still after this past week's dip, we're still higher than we were in 2018, 2019, okay? So economy right now is obviously far worse than it was in 2018, 2019, all the past years even maybe, but it just shows how overinflated the market is. And if you guys think that's crazy, then you have to look at this, okay? So this is the S&P chart from a PE ratio. Again, and PE stands for price to earnings. That is, again, it's price to earnings. So it's price per share to earnings ratio of these companies. And this number is kind of what the S&P would look like if it was based on actual fair value and PE ratios. Okay, so right now, technically, when you gauge it this way, we're at all-time highs. Okay, so the market is factually, from a price to earnings perspective, which again is a very important metric when evaluating the fair value of a company. Okay, so this just shows how overvalued and overinflated the stock market currently is from an actual value perspective. All right, so again, this is insane, you guys. We have blown past all-time highs here, again, on this metric. But this is, it's just scary to look at. This is a scary chart to me, okay? So that said, let's move on to these. You know what, we'll start here and then we'll end in the macro scale, because then I'll probably just rant at a macro level, okay? Because again, I think the macro right now is the most important thing to keep at the front of mind. All right, so here, very basic. I just want to show you guys this general trend line. I did mention this in the bubble video. This general trend line that we've seen over the course of this relief rally. So again, March low. We hit the low in March after that flash crash, and then since then we have been posting higher lows, higher highs, and the market's been looking good. Okay, again, this is a dead cat bounce, relief rally, whatever you want to call it. We see these across history: Great Depression, 2008 financial crisis. You see a sudden move down, and then you see a relief rally. People get optimistic. People get people see a V-shaped recovery happening, which is actually crazy that it happened to play out in the markets this time around, which we did see a V-shaped recovery in the markets. But it's not uncommon. Like, you can look back to the Great Depression. We won't do that now. I've done that in previous videos. But dead cat bounces are something that happens many times in history after a significant drop in price. All right. So we've set higher lows, higher highs. We've been on this relief rally. And just this past week, we broke the trend. Okay, so we broke this line of support that this relief rally has been bouncing off of, used as a place of support over the past couple months, and we are now technically in a downtrend. All right, so I did say this in the last video, but I do think it's still possible. I do think we can use this if we just expand this a little bit. I do think maybe next week, if for some reason there's optimism, which I personally don't think, I think next week is going to be pretty bloody. I do think we could see this used as a line of resistance, but I do not think it will pass above this. Okay, so best case scenario, most bullish case scenario, in my mind at least, I always remember, you guys, it's just my opinion, this thing could just keep going to the moon if it wants to. That could very well happen. I don't think so. I think the most likely scenario, if it does move up, it will use this as a point of resistance and then bounce down and then continue that move downward. All right, so that's just kind of a general thought right there. We'll look at this a little more detailed. So again, you can see this is that same relief rally on a daily time frame. You're seeing just over the past few days, just this past week, lowering highs, bearish sentiment. MACD on the daily time frame is falling, so that's a moving average, convergence, divergence. I don't personally have those on my charts, but that is a very popular chart among traders. It does hold significance. I just don't use it personally. But you can see this is starting to print an obvious downtrend. It's definitely curling down steadily, which is bearish as well. And again, just lower highs. It has broken trend right here, which is the most significant, just kind of like TA 101 piece of information in my mind, that it is now like technically started a downtrend. Okay, so that's that. And then just this is pretty important on a macro level. All right, so this is what's called bearish divergence. And bearish divergence, basically, because I don't want to get long-winded on this, is when you see charts going up, but RSI and a lot of technical indicators are pointing downwards or trending down. Okay, so you can see RSI here, which is Relative Strength Index. You guys can look that up if you're not familiar. Very popular. I think RSI is my personal favorite indicator. But as you can see here, every time there was bearish divergence on a macro level, again, these are 1 month candles, so this is a very macro, like bird's eye view look at the markets. Okay, so every time we've seen this bearish divergence at a greater scale time frame, we've seen a significant move down. All right, so here you can see here in 02, this is the dot-com bubble when it crashed. 08, obviously the financial crisis of 08. You saw RSI once it actually started to break down, and at the end of the correction, before these started to move up again and before RSI actually changed direction, we saw it cross the 30 mark both times, okay? And 30 is just like a pretty standard. That's why you see this purple bar. 30 is considered low RSI. Anything under 30 is dangerously low. Under anything above 70 is like a dangerously high kind of. And you can see, like, even before the market did correct a while, or actually that was 2018, sorry. But RSI was crazy high in 2018. We saw a pullback then. RSI was fairly high at the beginning of this year, but obviously COVID caused it to crash, and that was kind of a black swan event. But nonetheless, every time we see a significant correction, every time we see a recession or depression, which this objectively is, there's no way that this doesn't almost convert into a depression, sadly. But just keeping it real, I do think we will have to revisit the 30 level RSI on the monthly time frame, and that should bring us significantly down. If you guys did watch the bubble video, you'd know. We'll go back here and we'll just go out to, let's go to like 5 year. I definitely don't see it as out of question to come back down and retest this area where we spent a lot of time around in January 2015. Like, again, it's crazy to think about that, you guys. Like, even this crazy pullback, which seems so insane, and it was because it was so sharp, we still didn't even get down to levels that we were just chilling around, that were all-time highs in 2015. Okay, so keep that in mind. And then worst case scenario in my mind, just to reiterate this, is that we pull a pretty much full 50% retracement. And you guys, if you go back in history, a 50% retracement in the markets when the economy is so bad like it is right now is not a crazy thing to see. You saw it in the Great Depression, saw it in 2008. Like, a 50% retracement is not a crazy thing at all. Okay, so again, high in 2000, high in 2008, before the markets, before the tech bubble, before the financial crisis, seemed like a pretty rational place to correct back to, in my mind, in terms of, in regard to the general equity markets, okay? And plus, that would be an exact 50%, not exact, but roughly 50%. Go up from a high of, where were we at the beginning of this year, at about, call it 3,400, down to 1,500. So that's a little over a 50% correction. I would actually say it's more like in the middle here, probably around like the $1,700, $1,800 region, but somewhere between these two, just to kind of I know that's a huge range, but it just kind of it gets the point across that I think there's going to be a significant pullback. Okay, so just to wrap this up, just be safe out there, you guys. Like, again, it is just worrying me that general consensus over the course of this relief rally with all the davey day traders, all the retail investors, Robinhood day traders, has become that stocks only go up, and that we're powerful enough as day traders. We have enough capital now to keep these markets floating and keep the markets moving, which again may very well be true. We'll have to see. I just can't see that happening. And again, a lot of these newer traders, I remember what it was like to be a newer trader. You have weak hands. You haven't been in this game long enough to develop a strong stomach. When you see red, when you see like red, not like this, like red, you're going to sell. And that will cause, again, another butterfly effect. That will make waves in the negative direction. So you guys, I see a lot of rough waters ahead. Just stay safe out there, stay smart, stay rational, and just play safe, you guys. Play with nothing. If you do want to play this, if you guys want to trade this, I always want to get the message across. Don't play with more than you can afford to lose. So just be safe out there, and we will call it there, guys. If you do want to check out how I'm trading this current market, what my put option positions are, how I'm hedging my bets, you can check out my complete portfolio and daily newsletter down below. First link in the description. Exactly as it states, it is a complete breakdown of my entire portfolio, all call options, all put options, because there are certain things I'm very bullish on while the market is going down. I've talked about them a lot on the channel. I'm sure you know what they are. yeah, if you guys just want a complete breakdown of my portfolio along with each position, I do send out a newsletter on every trading day, and I just talk about the trades I'm making that day, why I'm entering positions, why I'm exiting positions, what I'm bullish on, my thoughts on the market as a whole. It's just more real-time updates from myself if you're interested in that at all. So again, check that out if you feel like it. If not, no worries at all. But we will call it there, guys. I'll do my best to keep you posted on this. This is very exciting times right now, scary times, but just remember, just keep a solid community around you. That's why I'm so thankful for you guys, and I'm just so pumped on this community that we are creating around this channel. And I learned so much from you guys as well. Like, drop a comment down below if you think I missed anything, if you think this is absolutely outrageous what I'm thinking, or if you agree with it. So, love talking shop with you guys. Love learning from you guys. I truly appreciate you guys. So, I will catch you guys next time. Until then, take action, make waves. Peace. Yep.